Let's start. Let's continue from what we were doing in the previous session. I'll just do a quick recap if anyone who by chance missed out. We started with the basics of the AFM batch, in which we have done few terms. First was EPS, then we had dividend per share, then we had a payout, retention ratio, dividend rate and yield. Rate was with respect to face value, yield with respect to the market price. Payout was proportion of the earnings we pay as a dividend, and retention was proportion of the earnings we retain in the business. This will tell us whether the company is in the growth phase or not. Then we move to a price earning ratio, a very important ratio, practical side. That ratio will tell us that which one is cheaper or which one is costlier in the relative term. So we do not look at the absolute prices of the shares. We look at in the proportion basis. That was P ratio we have done. Lower the P ratio, better it is prima facie. Although there could be n number of factors which will be differentiating between them. There could be a reason of the growth. Some companies might have a high growth, and because of that they might have a high P ratio. The next part we move to the market cap. Market cap was share price into shares outstanding. Then we had done the beta, which is a very important part. Beta shows a relationship between the movement of a stock and a stock market. The if I say, for example, the beta of the stock is 1.2. For example, if the beta of the stock is 1.2, what it means is that if a market moves by 1%, this stock will move by 1.2. If the market goes up, the stock will go up by 1.2. If the market goes down, the stock will go down by 1.2. So the higher the beta, risk was higher, risk would be higher, return would automatically, expectation would be higher. It's a very important part, because the formula what we have done in the in that formula, when I'll put the beta, once we understand what beta exactly means is, we would be able to make a sense out of it. Then next we move to what? We have few points. Then the market beta was what? 1. Market beta, because relationship with itself would be 1. That is exactly what we have done. And let's look at, that was note number what we had. That was note number 9. I think beta was 9th note. Let's put down the next one, please. Let's put down the 10th one. Methods to calculate KE. Calculate KE. I'm going back into your interlevel where we started the basic part of it. So what we have, one of the methods was dividend discount method. Dividend discount method. DDM, you used to call it as a dividend growth method also. DDM, or you can call it as, although we'll cover this method in detail in one of the chapters. DDM or dividend growth. Okay. One of the most important formulas. In fact, you had the full dividend chapter in your interlevel. Second was, you might have touched but may not have done it very aggressively. Capital asset pricing model. CAPM. Capital assets pricing. CAPM. The most used practical method, and maybe one of the only used practical methods. It's the most important practical method. This method has a lot of ingredient which will help us arriving at the cost of equity. The KE. Any other method you remember? We'll put down small formula. The way we have based on dividend, it can be on the earnings yield basis also. Earning yield. Now the moment I write earning yield, my formula becomes yield is with respect to what? Price. So it will be EPS divided by price into 100. And the fourth method, the name is not there. I could have said it's given by your Institute of Chartered Accountants of India. So based on price earning ratio. K is equal to 1 by P ratio. K is equal to 1 by P ratio. Now how does that formula comes out? If we try that formula, what is a, if I try this, this will become what? P ratio is price by EPS. This will become automatically EPS by price. Now under what circumstances to use this method, which I let you know. P ratio is one of the very important ratios you have. If you look at the P ratio formula, P ratio, if you go back and check, it's a price by EPS. You can calculate P ratio. You can reverse calculate KE, what he has done here. If P ratio is available, if EPS is available, you can calculate the price. It will become a valuation method. Means there are n number of things which can be calculated interchangeably. Under what circumstances, what exactly do we calculate? That we'll see once we move into the respective chapters. So that's some of the formulas we have. Dividend discount method, anyone knows, remember the formula? Although we'll be covering this in one of the chapters in detail, but since you had this formula, you might have done in cost of capital chapter as a KE, and in the dividends chapter, this was formula to calculate the price. So both methods you used. KE I can use, and with this method I can calculate the price also. Anyone remembers the first part of the formula? Dividend discount method? Oh my god. So inter we have cleared long back, or maybe 6 months back, or maybe 10 days back. Institute reserves the right to ask anything from you from CPT World, Inter and Final. That means final anyhow you have to study. You cannot leave anything which you have done in the Inter. This formula anyhow was used to part of the finals. They shifted to the Inter. So Nalaik full chapter you had. So much of a pressure. Oh my god. KE is equal to D1 divided by eh? Means one thing is for sure, you might have learnt very hard or crammed very hard. At least you know that something was KE minus G or KO minus G and so on. Actually, what you were trying to say was a price formula. Price is equal to D1 divided by KE minus G. So let us not disturb it today. It's a perpetuity formula. I thought I'll show you derivation. Well, derivation I'll show you in one of the chapters when we move. In security evaluation, that will be a price formula. This what you see D1 by KE minus G. It's a dividend, constant growth dividend formula. It gives you the price or summation of dividends till infinite, growing at a constant rate G. So I'll not disturb this formula because it requires half an hour or maybe a 25 minutes time to explain the formula. So the respective chapter when we move, we'll do it. Just keep it as it is. Do not worry that how that is derived, etc. Derivation I'll do it. In fact, any kind of a derivation which is non-engineer based derivation. Engineer based also, I'll tell you the hint also. Engineer based in which you use calculus, for example. You might have heard this name calculus in the CPT world, if not 11, 12, integration, differentiation, so on. Now that kind of thing, I'll just explain you or maybe tell you that how exactly they are doing. But wherever my explanation can be done in the language term or normal term which a layman can understand, will do that so that you get the support of it. For example, this formula is so very important for me, d1 divided by k minus g or d1 divided by price plus g. It's a so very important formula. I cannot do it without a derivation because that formula would be replicated at few places when I do the valuation of a free cash flow based models or I do a dividend discount, because this method anyhow will keep coming to you. Now what does this mean is, it just basically with the help of a dividend he is arriving at a price, and or we can reverse calculate the KE. Why it comes KE minus G, why it comes D1, do we take only 1 year dividend, that any kind of a doubt which comes, hold it for some period of a time. The moment we enter security valuation, I'll do it. My objective was to move into, because we have done the beta part, I just want to do the KPM so that you are able to read that formula in the language term. Anyone who remembers a KPM formula, please? Anyone who remembers? RF plus beta into RM minus RF. RF stands for risk-free rate of return. Risk-free rate of return. Just copy that down. We'll discuss in detail. Beta, what we learned is beta coefficient. RM is equal to return from market. Return from market. And RM minus RF. RM minus RF is known as market risk premium. Market risk premium, MRP. How to read this formula? I'll take help of an example and data. Just copy that down, please. Copy it down. Market risk premium which comes out. Now this model talks about is that I need a risk-free return whether I at zero. Beta of market was what? 1. That means if you take a risk equal to market, you expect beta is 1. Now the moment you say risk-free, what is the beta of a risk-free? What do you think? What should the beta of a risk-free? 0. Beta of a risk-free is 0. That means the risk-free return you require without taking any kind of a risk. Practically, if I speak, there is no asset in the world which is risk-free, even the government's default. But for the purpose of valuation, at some point of a time, we have to assume some assets which have to be risk-free. That means if I do not assume any kind of asset which is risk-free, I cannot do any calculation in the world. Otherwise, even the governments, even the good governments default. For example, the Greece defaulted in 2011, one of the big countries which I am taking, and you'll find n number of countries which default over a period of a time, means one or the other. For example, the situation we are standing as of now, practically, if these things slightly worsen from here and the Fed increases slight of interest rates, the way we have RBI, the Fed is for the US. If they slightly increase the interest rates from here again, because if inflation is not in control, then the moment interest rate goes up, it will put pressure on lot of countries. The US money is parked in lot of countries, and if the rates of the US starts increasing further from here, which are already 5.25%, which is the highest, one of the highest in the history, if I say. So you might find if that rate goes, let's suppose another 50 basis point or a 75 basis point, the 100 basis point is 1%. So if by chance that rate goes up again, in that case, what will happen? The money which is parked from the US to those respective countries, the US will start taking away those currency back, and the moment it takes back, there will be pressure on the currencies which will come. So you should not be surprised if in next 1 year or so, we are standing today in the next 1 year or so, if you find that due to the rise in the interest rates and non-controllable of the inflation parameters, some countries have defaulted, even the good countries. I'm not naming any one of them. If you go back and read, you'll find that there are some countries which are standing on the risk of a default. Few of the countries could be neighboring countries to India also. So there is a very high risk which involves. So this risk-free, when we say, you would never have any asset which is without risk. But for the purpose of this model, when we assume the safest instrument of that particular economy as the risk-free. For example, if I am doing some work in my, sir, why are you using a word valuation? Actually, with the help of this, we'll calculate cost of equity. Cost of equity, if you look at here, for example, if you look at this formula only, it's a valuation of what? Price. It's a valuation of a price what we are doing. So basically, that will help me in the calculation of a valuation purpose. The moment we do the valuation, that KE would be used in the valuation purpose. So if I am doing a valuation, let's suppose any Indian company, I would be looking at what is my costing in the Indian terms. What you say actually a costing from the point of view of a company, it could be returned from the investor's point of view. For example, the company raises some money. If you look at the balance sheet, if you look at, try to analyze the balance sheet which you've done, because I don't want to go into that specific, otherwise introduction will take a lot of time. Let's suppose you have a balance sheet. You have something called equity and debt. You would have learned in your very basics of the uh, financial management. The FM revolves around two functions. That's first part is procurement of funds, and second is called utilization of funds. That's procurement and utilization, and then you keep getting the return. Now, what you have on this when the company raises, there is a cost involved with the debt, which is a direct cost you are able to analyze. There is a cost involved with the equity, which is sometime you can directly attach if dividend is paid. If dividend is not paid, that does not mean there is a free lunch in this world. There is a costing of the equity which comes out, and that cost is called cost of equity for the company. If it's a cost for the company, then I am giving to as an investor, that for me it becomes what? Return. That becomes a return. So, and then company puts that money in the business here, and they run the business. What they earn from here is return on investment, return on equity, what you have learned. So that comes out here. That will also become one of the parts of the chapter. When required, I'll come back. So what I mean here is, when you say, sir, why we are saying a valuation purpose here, cost of equity, the cost is from the company's point of view, because any kind of a company, when they're doing the valuation, they should know what the expectation of the investors is on that money. If they're not able to fulfill that out, then there is no use of taking any kind of a project which comes. So basically that stands as the RF. RF, for example, will tell you that this is the minimum return which I need without taking any risk. Let's suppose if I'm in India, the India safest is the government. So you can have the PPF rates, for example, or 10-year, the national bonds rates and so on. These will become the risk-free rate, 7.1, 7.2 as of now. That becomes a risk-free India. Similarly, if I go to the US Treasury, whatever their rates are, whichever the government or treasuries they have, the safest, that will be the risk-free from them. And then accordingly, we'll apply the different parameters. So risk-free, I'm saying it again, there is no risk-free as such. Any kind of asset can default. Even India can default. It's not so. As of now, we do not have a position. But let's suppose if something very bad happens, we also borrow from the outside world. There could be a possibility the default can come. So, but I can tell you, when you go back, just see the search if you want the neighboring countries to India, which the risk of a default, you will automatically come to know which countries are standing. Sri Lanka, I think, was already part of it, which has already done their part. So, and it is not India we are talking about. There could be some American countries, there could be some European countries also, which are standing on here, because the inflation and the interest rates are standing at such level which are beyond imagination. And that has happened. Some part it has already happened. People are spending, because people have been spending so aggressively. The credit became so easy after the COVID. The central banks pumped in so much money into the market, and everyone was spending. Now, when they are tightening it up, it's becoming difficult for them. And second has been because of the Russia and the Ukraine. Now, if anyone thinks that Russia is not able to win against Ukraine, then they're making fool of themselves. They are playing a very silent game, which anyhow in the free time, if we have, will try to read out that they are playing very silent game. They know that the longer we continue, maybe the longer would be the pressure on the European, the US economy, which will be there. So there could be some different political reasons of it, which has put the pressure. In fact, UK came in a problem. UK came in a huge problem, and still they're standing in the risk of a problem. And that is only because of inflation, and inflation is only because of the change in the interest rate. Some of the generations in the European economies might not have seen the kind of interest rates of the inflation they are standing at. And these kind of a data also makes that movement in the currency rates what we find. So KPM model is actually, I want to restrict to my KPM model only cost of equity, because these what I discussed become part from the day one in the chapters. So KPM is one of the models. I have not discussed rest of the items. The beta and RM. RM is written from market. For example, market is the India. If we talk about, we say market is National Stock Exchange or Bombay Stock Exchange, NSE and BSE. So what is the return from the Nifty or Sensex comes out, which we have not discussed in the yesterday's class. Today I'll be talking as a separate part. Third and the fourth formula are only to be used if you get stuck somewhere. They will not be used aggressively. Fourth, in fact, will be using at lot of places, because you will have such a kind of a data in which you might have to use. But the third data, the earnings yield, would be a very rare circumstance you will be using it. So I'll put down a new heading as a KPM. The first method we'll discuss in the respective chapter, dividend growth or the dividend discount method. We'll discuss in respective chapter because it's a complete formula which requires a lot of detail. KPM I'll discuss with you so that you can at least read out in the language form that how we speak the KPM in the language form. Let's put down the heading as a KPM. Let's put down the heading as a KPM. Let's put down the heading as KPM. Now I'm just putting some data. You need not copy anything from it. Do not copy anything from it. I'll just put down some data, and with that I'll try to read out that what formula means is. Let's suppose RF is 10 percentage, RM is 15 percentage. Please do not copy anything. RF is 10, RM is 15 percentage. Now, if I try to read risk free, I'll say I need 10% return by taking how much of a risk? Beta from 0. That means beta of a risk free 0. It means you need minimum 10% return without taking any kind of a risk. What is the beta of a market? Beta of market is 1. Now, if I use this language, if I move from 0 to 1, I need how much excess return? If I move from 0 to 1, how much excess return? 5%. Now, try to look at the equation. You said it's a RF. Please do not copy anything. Beta into RM minus RF. We call it as 10% I need without taking in risk. Beta I am leaving as it is. 15% minus 10%. I need 5% extra return. 15 minus 10 when I take a risk equal to what? Beta equal to 1. Then I say 10% plus beta into what? 5%. This becomes a KPM equation. CAPM. Now look at this equation what it says. It says 10% is the return which I require without taking any kind of a risk. I need 5% extra risk. I need 5% extra risk when the beta of the market is equal to what? 1. Now let's suppose you're investing in a particular security whose beta is 1.2. Is the risk higher than the market, lower than the market? Higher. Return expectation would be higher the risk, higher the return. You multiply by 1.2. That means your return would be 5 with respect to 1. With respect to 1.2, return would be 6, 10, 10. Anyhow you require, your total return becomes what? 16%. If you are investing in a security which is even higher riskier than this, 1.5, let's suppose, 1.5, then your return expectation would be 5 with beta 1 into 1.5. That will be what? 1.5 into 5. Alright, 5 into 1.5, 7.5, 10 plus 7.5, return would be higher. Market was giving you 15. If your risk is higher, return expectation would be higher. If your risk is lower, let's suppose you are investing in a security whose beta is 0.8, risk is lower than the market. Market total return is 15. Your total return will be less than 15 in case you are investing in a security whose beta is less than 1. If let's suppose beta is 0.8, it means 5 extra I need. 5 extra I need when I take a risk equal to what? 1. At 0.8, I'll take what? How much? 4. 0.8 into 4. That means just keep that equation in mind. 10% I need at any cost. The moment I take a higher risk, I need the higher return. The moment I take a lesser risk, the lesser would the return comes out. The MRP, if I have to try to explain, the MRP is the excess return when the beta of the market is equal to 1. MRP is nothing but it's an excess return over the risk free. The return which market is giving over the risk free. Risk free gives a return when the beta is 0 and the RM gives a return when the market beta is equal to 1 which comes out. Now using this data, I'll make an example. This is called the KPM equation. We can draw this one chart. In portfolio we'll be learning called a line called a security market line. Some people also call it as a security market SML equation. That line I'll draw on the chart here itself so that by the time we go to the portfolio, we're very comfortable that we have heard this term. My objective is very clear, please. Beta I should be able to read. And second point is when I'm doing my questions, I should know if beta is greater than 1, my return has to be greater than market. Sir, why are you using a word return? Because it's a cost of equity. Cost of equity is from the company's point of view. From the investor's point of view, it becomes a return. It's an expectation which comes out. Because it is not necessary that all companies would be paying dividend. It is not necessary all companies would be paying dividends, especially when we go to the, let's suppose, a startup business or any company which is in a very high growth phase. They are not declaring any kind of dividend. It does not mean that I cannot do the valuation of those companies. I can certainly do the valuation of those companies. It depends, all depends upon that what is the return expectation and how riskier is the business which comes out. Let's put down a small example, please. This data do not copy. I'll make this as an example only. Let's put them. Calculate KE using following data. RF is equal to 10, RM is equal to 50, betas I put 0, 0.8, 1 and 1.5. What we do here is, as per KPM, we'll always make an equation as per KPM, CAPM, as per KPM. K is equal to RF plus beta into RM minus RF. Very, very, very important formula, please. Theoretically, practically, both. A very important formula. RF is equal to 10, beta leave variable 10, beta into 5%. This becomes a KPM equation, CAPM equation. Now, this also means, sir, what it means? Risk-free would be same for everyone. Risk-free would be same. It is not the government will say, no, no, you are chartered accountant, will give you return only 5% because anyhow you do lot of things which disturb us. Or okay, you earn your income, family income less than 2 lakh, so we'll give you 8%. It does not happen, I think. That means risk-free will remain what? Same. Market also will remain for everyone what? Same. Only thing changes is, it means only thing changes in between is what? The company in which you invest. For example, you might invest in the Reliance, I invest in the Infosys, I might invest in some other company, let's suppose Vedanta, or it could be Tata Motors and so on. So accordingly my beta would change. That means the respective company beta would change, and the moment, for example, if we are investing in a company called Suzlon, it's a very high risky as of now, which is moving very quickly. It can be up and down, which happens. So the return expectation would be more, loss will also come more, or return lower side can also be a dent if the high risky security we invest in. So beta of the respective companies would change. How do we calculate? I told you yesterday also that will leave for the time being. The calculation we'll see in the respective chapters when we move to the portfolio side. But as of now, you should be able to read out. Now let's suppose beta is 0. Let's do it verbally. Let's suppose beta is 0. If the beta is 0, automatically answer would come what? 10%. Risk-free beta was what? 0. Risk-free beta was 0. 10% return risk-free. I'll get equal to that. If my beta is 0.8, 0.8 into 5, 4 plus 10, 14. I am getting lesser than the market because my investment which has been done is giving me lesser risk. Lesser risk, lesser return would come. If I invest in a company whose beta is 1, return would be equal to 15. That means even the market risk was 1. The company also has a risk of 1. That means return would be same as the market which gives out. And if I invest in 1.5, I am taking a higher risk, return would be higher which comes out. Now we only have to substitute the betas. Let's put on the first part. Beta 0. Although correct term is not KE, I tell you very frankly, it's RE, required return. The word is required return. I am not confusing you with this word because the moment I say, there could be some confusion come. Interchangeably we use this as RE. In interviews, anytime when you go, or let's suppose you get MCQ question that KPM helps in calculation of what? It's a RE, required return. These technical parts will come once our framework is done. Interchangeably at final we call it as a KE, ER, expected return, or RE. RE is the correct word, required return. That means what is the requirement? What is the requirement? That is exactly the KPM, but you can interchangeably use this name. It's a 10% plus 0 into 5%. We get what? Try to do the second and third part, please. Second, third, and fourth part. Try to do it, please. Just have to substitute the values. Second part, how much beta we have? 0.8. My cost of equity would be 10 percentage plus what? 0.8 into 5 percentage. How much do we get? 10%. Third part, beta is equal to 1 point, no, 1. We have beta is equal to 1. My cost of equity is equal to 10 plus 1 into what? 5%. How much do we get? 15. And my fourth part, beta is equal to 1.5. KE would be equal to 10 plus 5 into 5 percentage, 17.5. Now one thing is for sure, higher the beta, higher would be the return. Now same thing I can draw on an equation called SML line. SML line, security market line. It's a graphical representation of KPM. Once you've done, let me know. Once you've done, let me know. I'll draw that as security market line. We can put a small heading here. Security. SML. It's a graphical representation of CAPM. It's a graphical representation of CAPM. Now, when I say a graphical representation of CAPM, let us do check once before you copy, please. This line will start above 0 or from 0. What do you think? You know, it will start from above 0. Why? You need minimum. You need minimum what? 10% return. Do not copy, please. Just help me out. This is 10. Let's suppose then we had what? Return of 14. Then 14. Then was 15. Then 0.5. So if I try, so this will be this way. This will be this way. Now this will be, this is 0. This is what you have, beta. This will be A. It is interchangeably known as expected return or RE. Actually, RE is the correct term, which anyhow will come in the future classes. Now, beta first was 0.8. Return would be, sorry, this is 10. At 0.8, how much return? 14. If the beta increases to 1, return is 15. If the beta increases to 1.5, return would be 17.5. Now, if I would have drawn one more part of it, I would have said this above this part, the securities, that means above basically what we call it as above beta 1, securities are what? High risk, high return. So risk, understand risk does not mean here please loss and profit. It could be a fluctuation. It is a fluctuation. If you invest in a high risky, that means with the movement higher, your return would be much higher. With the movement down, your return would be much lower, which comes out. You can draw that now, please. Graphical representation of CAPM. I have to yet discuss with you market. I have not discussed the market. What exactly market means is that will come soon. Done. It's a graphical representation of CAPM. This is basically a SML line, secondary market line. How many notes we have done? Just check once. This was last was 10th number. Now 11th. 11th would be book value per share, a very, very important term. To help you understand book value per share, let me draw a small balance sheet. Equity share capital, let's suppose 1 lakh share. We started with 10 rupees face value. This will be 10 lakh. Over the years, this business has generated reserve surplus of 90 lakh. Now, help me out with the accountancy part of yours, please. Let's suppose this is a business of any XYZ or Haldirams or any kind of a food chain or any brand which is created. You go and ask him, and you ask him to sell his company at the rate of 10 rupees per share. Would he sell? No. Second part, go to the accountancy only. Go to the accountancy only. If I ask, it's okay. You have 10 lakh here and 90 lakh here. That becomes what? 1 crore. This total is known as what? You equity share capital plus reserve surplus. You call it as what? You net worth, or you can call it as a equity shareholders fund. Basically, I'll use this some equity shareholders fund. You call it as. This is only known as a total book value. This is also known as a book value. Now, if you say and ask him that yes, 10 lakh is there and reserve surplus 90 lakh, then total becomes what? 1 crore. Sell me at what rate? 1 crore. Will he sell? No. Anything else you've done in the accountancy? Or what do you think he would, or what, tell me how exactly you decide, or how exactly you would have done any part in anywhere in the accountancy or anywhere, that what rate he should be selling. It's above 1 crore, below 1 crore. If he sells above 1 crore, then exactly what do you do the adjustment for? Goodwill. You do the adjustment, that word you use, goodwill. Now let's come back. Remember that word. Objective was to explain you something. Now total is known as equity shareholders fund. Is known as equity shareholders fund. This is only what we call it as book value. How much it becomes? 1 crore. It becomes 1 crore. Now if I calculate book value per share, if I calculate book value per share, that will be equal to book value divided by what? Number of equity shares outstanding. Book value is 1 crore divided by 1 lakh. It becomes equal to rupees 100. Now this means if I try, I'm not writing on the asset side, I'm just putting some figures. Face value rupees 10, book value per share is equal to rupees 100. If someone asks now, what is the difference in the book value and what is in the face value? That is because of what? Reserves and surplus. Goodwill has not come. It's reserves and surplus. Now the problem is, in market when the share price exists, what I'm trying to tell you is MRF face value was 10 rupees, market price was 1 lakh. The C8 face value was 10, market price was 2400. Now what exactly is the difference which comes out? Now in this book value, if I add what you said in accountancy is goodwill, although not exact goodwill, there some could be few adjustment, but remember roughly goodwill. In finance we call them as a future expectation. In finance we call them as a future expectations. If I add this part here, it becomes share price. That becomes a share price. Let's suppose this price is 240. Let's suppose. Now you should be able to easily clarify that between 240 and 100 book value and this, the gap is of future expectation or goodwill because you'll be earning something because of your past efforts, will be getting a return. Between face value and share price, two impact come. One is because of reserves and surplus, second is because of the expectation. Now also understand MRF earning was what in the previous session what we did? How much was the earning approximately? 2000. Flip out the pages, 1900 something, 2000 was. If every year it is earning 2000, let's suppose for last 10 years, automatically that reserve and dividend he was declaring, I think 160, 170, 180. That means approximately 1600 rupees is added to the balance sheet anyhow. That 16,000 is added in what? Reserves and surplus. The moment I say it is added in reserves and surplus, the value would go up. I hope you are able to get my point, please. That means the price is going up because something accumulated profits are adding plus the future expectation. Now you have to remember that if we are in an extra bull run is when the markets are bullish, when the expectation is very high. As of now, what we are standing in, I don't know what will happen in 2030. Everyone is talking about 2030, will be this economy, will be that economy, blah, blah, blah. So a market, what is standing Nifty at 20,000, what Nifty is 20,000 will come very shortly. Nifty standing at 20,000, the Sensex standing at 65,000 plus, the Sensex will become 1 lakh, Nifty will become 25,000, 30,000 and so on. These are the targets which are coming in. Now they are expecting a very high bull run in the next few years because I told you when we are moving from how much, what is our size of economy? How much trillion? Approximately 5, 2, 3. Anyhow, work for tomorrow. Just find what is the size we are standing at and what is the expectation by 2030. And your politician will tell you even the dream of a 2070 when their second generation is also not there. But you can sell anything. You can sell. I'm telling you, in this kind of a market, the markets what has become. In fact, let me come back to that second because I'll deviate the topic otherwise. Because once you enter a market, it's very difficult to come out of it. Now, understand the objective of it. Reserves gets added. I'll show you some companies whose book value is less than the price. If the book value is less than the price, what does it mean? That means future expectation is very less, or maybe it's undervalued stock. Maybe it's a undervalued stock which we have. So there could be two possibilities you can have. If you find book value or price by book value ratio, you can have a. If I ask you what is price by book value ratio here, PB. Price by EPS ratio, how do you calculate? Price by P ratio, how do you calculate? Price by EPS. Price by book value, how do you calculate? If you calculate price by EPS, price P ratio, what comes first? Second comes what? EPS. How do you calculate price by EPS? How do you calculate P ratio? Price by EPS. Price by book value. Price by book value. Price by book value only, na, right? Price by book value. Price is 240. Book value is what? 100. If it is more than 1, it means your price is more than. Very, very good morning. I think Sunday should have kept off now, right? Price is 240, book value is 100. I am asking you price by book value ratio, P by B. Let's suppose P by B. How much will come? 240 by 100. What is the ratio come? 2.4. If it is more than 1, you know what it means? Price is higher than the book value. If that gap is high, let's suppose 2.4, 4, 5, 6, it means future expectation is very high. It means future expectation is very, very high. In case I have, let's suppose, price by book value, P by B, price by book value ratio, the lower side, that means either expectation is very low or there could be a possibility that it's a undervalued. Undervalued is basically no one is buying that stock and no one is knowing that stock. It could be a good deal which we might have. So you have to be very careful under what circumstances you are looking at. In time of a recession, even the good companies fall very near to their book value. In the time of a recession or the slowdown, which happened in 2020 for a short period of time, in 2008 when we had a financial crisis, subprime crisis in the US, then the extreme excellent companies were trading, I think, less than the book value which was there. But if you should generally find this price to be higher because that would reflect what? That would reflect the expectation. If the expectation is not there, then there is a problem. Even a high P ratio, if you have, price is higher, earning is less. Price is higher, earning is less. And if someone is buying, it basically would mean what? You can have either overvalued or there is a future expectation more. There could be a possibility of more. Sometime back in one of the group companies, in one of the group, we have found that some report came out. If you would have done, whether you liked or not liked, everyone would have spoken about that item only. Something came out in the month of January, Feb. In the month of a US company reported about one of the Indian groups, and price fell drastically. I'll show you their ratios also today. I'll show you some of the ratios. You'll imagine that it was not wrong. Maybe their one of the companies was having price earning ratio was around 100 times, 500 times also, I think. That means if you invest today, it will recover your money in how many years? 500. People are buying blindly. Blindly they were buying, and it could be possibility if basically that business evolves. It could be possibility. Now two things are possible: either your base earnings would grow very quickly. For example, my price is 100, earning as of now is 50 paisa. Let's suppose my P ratio becomes what? 100 price, EPS is 50 paisa. How much my P ratio becomes? 200. You might find a very high, but could be a possibility next year my EPS itself becomes 20. My by chance my business evolves and I had some money stuck somewhere, or there was some problem. The EPS came 20. The moment EPS comes 20, it will become what? 5. So the future expected, it is not necessary that it will not change. What we assume is things will not change. So when you are looking at any higher P ratio companies and still people are buying and fund houses are buying, it means there could be something which we do not know. So what I say from my theoretical purpose is it's expensive. It might not be expensive. And when I say price by book value is lower, let's suppose price by book value is lower and people are not buying, that means there could be some problem which market is anticipated, because market is supreme. If market gives you some valuation, we should know that valuation is being given. So objective is understand a difference between the book value, face value and price. Higher the difference of the face value and price, that means either your reserves are very high or there could be high future expectation which is there. Copy that part please, man. Quickly copy that part. Once you're done, let me know please. You certainly cannot keep a track of everything, all the companies or a number of companies which I speak or which you hear. But at least I want two, three, one sector at least, or maybe two sectors and couple of companies keep tracking different parameters so that you know that what exactly cover up what you do that makes justification. Now, before discussing that Nifty, Sensex, etc., since we'll discuss the book value per share, I think that's the last note we have as of now. It's a book value per share you got. It's a book value divided by the share outstanding. I'll show you now some of the companies. This data what you're calculating would be available in the market very easily. You should know the sources, some of the sources. Not every time you have to go there. Can we go back? Let's look at some part here, please. Show you. The most important is the BSE NSE website. Or you can have. Let me come back here. It's not that every day you'll be watching this kind of a screen. It's only because relevant data is required. Now, some of the companies I'll show you. Let's suppose Adani. Let me take Adani has a number of companies here. So which company should we go? Let me go to transmission. What is the price? 75. What was 52-week high? 4,000. It was when before that report happened or came out. Now this was what date? 16/9/2022. 4238. Whatever was the highest. As of now is 775. EPS, P ratio, and imagine if it was 52-week high price, same EPS. 4,000 divided by 1.68 do it. 4,000 divided by 1.68. In how many years? I think I don't know how many generations of yours have to get a rebirth. In this also, how many generations will take a rebirth? Now it means maybe that price was moving higher. The EPS base has to increase aggressively. EPS has to. Let's suppose next year EPS becomes 100. Let's suppose by chance, I do not know. I do not invest, do not track any kind of a companies. Any company which I discuss is educational purpose. Whenever I'll open this up, I'll say. If I don't say, you automatically assume, please. If it becomes 100, the P ratio will become 7. That means your money would be recovered if I say roughly in 7. As of now, how many years it should take? You can imagine the kind of a ratio you have. So understand the meaning of it, please. Still, someone is buying, or some big people are also have taken a stake. One of the fund houses have taken a stake in this company, in this group. That means they are expecting something which we might not be able to see. If I show you some other companies, Adani has a whole lot of. You can make Adani index itself. There are so many companies. Let's say Adani Enterprise. Price is 2,400. Highest was again 4,000 something. And look at the P ratio. That means a growth expectations are very, very high. And if they are not met, you can imagine if they are not met. Let me show you something. Which I showed you Adani. First one, transmission. This is transmission. I go back here. Chart. Very good, very good. Range. 1 year. Look at the chart, please. Look at in 1 year what has happened. Can you see that fall? It was trading somewhere here and then suddenly January 23 and this is what? 27/8. You might not get the feel of the fall. Maybe you said it's okay since you're not holding. Even if you're holding 10 shares of this company or any company that falls, I'm telling you, day in, day out, you'll open up price, what has happened. And they are some of the companies, for example, Adani Enterprises. Let me go to that company, please. That company is part of FNO. We'll have derivative segment in our course. That's part of FNO. I don't know because I do not do activity in the FNO part here. So lot size if it's available, let me check. I don't know what is lot size here. That lot size I do not know, but I know one thing that 4,000 rupees lot size was maybe 200, 250 shares. Means FNO, I think 250 shares, roughly if I remember. That means that in FNO you have to buy at one go 250 share or sell 250 share. If let's suppose someone would have bought, the highest was around 4,000 or 4,250 shares lot size, and it came down to 1,000 rupees in a span of here, from here, stand here and come down to this. It came down, it's not showing you that this thing. I remember this date 27th Feb because I went for my daughter's admission in the school. I cannot forget this date. The way my car was moving, and some people were calling lower circuit 10, another circuit 10. I said, why are you disturbing me, Nalayak? I'm anyhow do not have any position or I do not do it. But by the time I reached there, the fall was there, and same day from 1000 it went to 1700. If you look at this curve, you cannot feel that out. Let's suppose you're holding 250 shares. Let's feel imaginary 4,000 becoming this in one lot. How much loss comes? And I'm telling you, there could be few people who would have lost in a single day, maybe 1 crore, 2 crore, 4 crore, 10 crore, 50 crores, and they did not cut out the losses. It's exchange cuts out their losses. Exchange says you are not able to pay more money because we'll do derivatives. In that, I'm just giving you a feel. In that, you have to deposit some margin money. In case margin falls short, then automatically they might not give you a call because time is not there. It's falling like card, and they say cut, 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 cut. You are plus in the minus, and they'll cut out. And then suddenly, every 1,000 it came approximately. I think 999 somewhere, 1,000 it came that day. And from there it rebounds same day 1700. Let's suppose you would have bought 250, imaginary 250 shares, 1,000 rupees, same day 1600, 1700, 700, 250. How much it comes? Divide by 5,000 stipend per month. You can imagine. So making money is also possible, losing out money is also possible. The FNO is part of your course. I cannot help it out, but one of the most dangerous. Share market is not dangerous at all. Cash market, what we call it as, it's not dangerous at all. You buy, sell, you'll buy what? 5,000 rupees I have, I'll buy 4,000 rupees share, 3,000. I have 1 lakh rupees, let's suppose I'll buy 90,000. But FNO is people over leverage because you deposit small margin and you can buy big. For example, if it's a lot size of 250 into 1,000, 250, 2,50,000, there might be possibility exchange will say pay only 50,000 or 1 lakh rupees and you can buy the item of 2,50,000. But what if falls like this? So the fall came, and still you can imagine where are we standing. Still you can imagine where are we standing. Second important part, we learned what book value per share just now. Now come here, come back here. If you look at this data, these data points, why I am showing you is, if in your office you have a free time, which anyhow you do not have, knowingly or unknowingly, no matter at any point of a time, the moment you have free time, someone will come from the back, your senior, open GST site, open income tax. Along with that, you can open this site also, and there is a alt tab button, alt tab in between you can do. So that you cannot do anything. You have to work accordingly. Now in this, look at this part here, book value per share 228. Can you see in the extreme right? Right, this one. Book value per share 228.24. What was the price of this share we had closing? Closing was. You can imagine roughly price. It was 2420 245 2450 2400 2400 divide by 228 something, do it. Approximately. Can you see that P by B? That means it is something which you are learning, will be data would be available here and there. Exactly if I go here, which company were we seeing this? That was enterprise. This company, this. Now why it is showing, I don't know why it is showing 19.7, but the if you look at this book value 228 and this it shows data here. Now second important part is the P ratio. Well, for example, look at this. If you look at the growth of the EPS, it has grown, it shows 207%. Maybe that P ratio was higher. I'm saying it again. Maybe that P ratio was higher. Reason being, P ratio is higher because of the reason that the EPS might grow very fast. It is not necessary the high P ratio would always be expensive. It might grow, but you have to be careful if some companies are giving which are unknown, which business you do not know, and they are trading at a P ratio of 1,000, 2,000, 2,500. You will find a company, then that means there is some problem. Why invest in that company? There are n number of companies. For example, let me show you. Let me show you this company. Now, in this company, I'll show you the chart first. Look at only 1 month chart, or look at the look at this chart for in or 1 year. Let me show you. Entire 1 year, this chart remained only once it went up here. After that, it was trading at same range 140, 150, 140, 150, 150. These charts will come in your course in the technical analysis. So get habitual about it when reading charts. And then suddenly one day here from 160, 170, and in how many days? It's a 3 July or 4 July. Can you see the date also somewhere? The increase is price. Now this I'm standing here. It's around July or June end, and it went up 19th July or somewhere from this level to this level. And actually, if you watch any data, any point, nothing has happened in this company. Means earlier also it was same, now it's same. Nothing has happened. Now think of a position, what has changed? This company was trading less than its book value at this point of a time. I have been tracking this company for a different reason. You do not have to track. This company now has entered a ESM stage in which there is a problem, means it's a margin is required, etc. So you do not do. I was tracking for some my purpose because I'm tracking this sector for some purpose. Now this price 3rd July was approximately 161.70. I'm just telling you a hint. Look at the book value per share. Look at the 231. Results of this quarter has not come till now. That means this book value was in the March. Still now this is valid 231 point something. Price was 170. Oh, you can imagine 170. 170 divided by 231. What was the P by B? 0.7. It was showing me two things. Either this company is undervalued, or there is no growth opportunities in this company. Now suddenly in 10 days results have not come of this company. If I go back and check here, in this case, if I go back and check here, in this case here, nothing has changed. Results have not come. The last results are of March only, which is standing. It has not come. Now if I look at the price became around 272 2 days back. It is now stopped at 250. It's in a 5% circuit now. It is to around 250. 250 divided by do that book value. 230 book value is not changed. You know book value changes when actually? When results comes out, and result in India comes out every quarter. March is a full year financial year. That means remind me in case you have, just note down this company only. If the results come, we'll watch after this. The result will come very soon. This is we are standing on 20. This is what date we are standing? End of July, na? By 15th of August, results will come. I'll show you a few companies so that just try to analyze that what actually you are studying can be seen, and that will become a habit once you go in once the course is over. My requirement would not be there. 231, its price is 250 divided by 231. How much it comes out? 1 point. Can you see the P by B? Can you see that P by B here? 1.09. Is it matching? Yes. Now second is price earning ratio. The EPS of this company was 29.67 10 days back also, 20 days back also, and after April, around April also, after the March result, the price was 170. 170 divided by do that 29.67. It was a very low P ratio. That means your money would be recovered in 5 years if company earns at same rate. Now since price has increased, EPS has not changed. I am telling you some parameters what changes. Price will change every day. Price has changed to 250. EPS has not changed. That means your P ratio has gone up. Now that means your valuation has become slightly expensive than previous 20 days or 1 month time it has become. Now it means is either this company has to continue reporting the same number, or maybe some investor might have found some interest in it. We do not know what has happened. So I'm just taking a name of the company because this company has remained stagnant. If I want to see the chart of it, the long back which was there, If you look at the 1 year chart, look at the P ratio 1 year, which was trading around what? It's a 0.75. Look at this 0.75 point, never exceeded what? 1, and suddenly now it is above 1. The similarly, if I look at the P ratio chart of the historical here and I try to analyze, look at this. Suddenly, what has happened? The EPS has not changed till now. It was trading in what range? Very consistent range, around 6 times or below 6, and suddenly now P ratio has become what? Above 8. That means two things are possible. Either something which people were not analyzing earlier, the growth expectation that will come in this company, or maybe some investor has found interest in this company and things can move. Similar type of a company, not similar type of company. I remember two companies which I was investor for a long, long time. Means luck is bad, luck is bad. You cannot make a money when your luck is not there. And at least 9 to 15 years I would have held those companies. When I became a CA after that, I had the love for it. So amount was also decent amount. Decent amount means comparatively with the stipend, was a decent amount. But that amount itself, you can imagine, became 100 times. But my luck was not there. I exited at maybe 1.5 time or a 2 time. That companies I'll not show you today. Once we move into the chapters, I'll show you some companies. I'll show you exactly same graph. 9 years, some companies remain stagnant. Please do not invest in this company and just track this company. It's a Calcutta-based company. I track for different reasons. I have some sectors in my mind, some companies in my mind which I track. It's in textile, I think. So what I'm telling you is, suddenly you will find two things have happened. Now another company which I was showing you, which just Friday things happened. Let me show the chart of that company. I'll show you some of the charts. Don't worry. I'll show you one company. Very interesting chart. I don't know if something black box. You might be hearing this name also. Very odd names I'll be taking because everyone knows Nifty companies, Sensex, which you will also know. These are few companies which I track for some different reasons. By name, it appears as if it's a black box of a what it appears. By name, black box. You know what is a black box? Anyhow, whatever you see, our knowledge is so great, general knowledge, because we do not get the time out of the study material. What can we do? It's a in case any time when you go na, if do not know, then what you do is just put in like this in the any of the websites or BSC itself and see the sector. It's IT enabled company. The name was not a black box. I don't know why the name they have changed in the last 2 years back or 1 year back. They changed the name. I'll show you the one of the classical examples of the graph. No, look at this part here. When price moves up, look at the way they move up, and somehow if someone gets stuck at this point of a time, then I don't know how many years will take to reach this level again. And then it came down, it came down as low as March, I think, 80. I'm telling you the riskiness of the market. Riskiness, because some people, we generally have tendency, market always gives a return. It is not necessary. If someone would have bought here in 2021, 333 or 330, the price in the March came down to 85. Means at least I'm very sure he will tell 10 generations of his or write on the note, do not invest in the market at all. Do not invest in the market at all because the experience is very bad. But someone who would have invested here in the Feb or March and now the price becomes 200 will say you cannot have better return than the market. So perception, understand. So it basically tells you is you have to be very careful. Market can make you fall or grow like anything. It depends on the circumstances. So never invest the full money. We'll be learning some principles in some of the chapters. Never invest your money at one go in one point of a company. Always make sure that you have a exposure which you can bear or which you do not have to even think about it. Think, for example, if I have a earning of a 10,000, let's suppose, if I am not invested in market, I'll advise very good. You have an alternative, and especially when the interest rates are so high, around 7.5 and 8, market consistently cannot give you a 10%, 12% return unless and until you are in the blue chip company. Otherwise, you have riskiness. So that becomes a danger. Although objective was not this to just to show you, because graphical presentation will be part of my technical analysis. My objective was just to show you the price earning ratio, book values, and the P by book values, P by book value, so that you know that how do I track, how do I know whether the company is risky or not. If the price is higher, EPS is less, that would mean one thing. It could be price P ratio is higher, maybe because of the reason that growth is there, or it could be overvaluation. That means the things are very expensive. Even difference in the price and the book value comes, that means future expectation could be very high. If the price and book value are low, that could mean either no one is expecting anything from that company, or no one is knowing about that company. So it could be you could be the you can take a first mover advantage also of that kind of a company which comes out. So these were few, lot more companies are there which will be doing different valuation the purpose. Now second part of this was the ratios which are there. Second part was we have seen the market, return from market. Now what exactly market means is, I'll close this off. Market means. Now let me go back to my work here. When we say a market, after today's class, I would expect from you is what? I'll expect if you stand somewhere and speak, you should be knowing what Nifty is, what Sensex is, what does Nifty 20,000 mean, what does Sensex 66,000 mean, what exactly they mean. I don't want it to sound dumb in front of anyone. Maybe they'll be used directly, indirectly, because Nifty, Sensex, these will be common terms in the questions. In the next chapter itself, we'll find that, because any chapter what we'll do, they'll have a link with the market, because your return cannot be calculated comparative return without these calculations. Now let's suppose I make, let's say, market here, and rough work I'm doing. This is not the fair work which anyhow you can do. Two popular exchanges what you know is NSE and Bombay Stock Exchange. You know that. Although there could be more than 30-35 stock exchanges in India. How many are surviving as of now? I have not kept track of it. We have a Calcutta Stock Exchange, for example. There used to be Ludhiana Stock Exchange, Delhi Stock Exchange, even Hyderabad Stock Exchange. You know where is Hyderabad Stock Exchange, by the way? Anyone? By chance? You know Hyderabad, by the way? If I tell you exactly Hyderabad location, you know, you from outside, it's okay. Imagine that out. Whenever you go to a new city, always try to learn about that city. Some beauty will come. You know Tiwari brothers, eating outlets. You know eating outlets. Maybe looking at your sizes, you might not love food. I love. It's okay. You know Panjagutta. From Panjagutta, you go towards Lakdi Ka Pul. Yes, some of you know. You do not know. It's okay. You imagine where I am going. Imagine. From Panjagutta, you go towards Lakdi Ka Pul. Somewhere on the right hand side, Decathlon comes. It comes fast. Left hand side, petrol pump comes. Two petrol pump comes. Or you can say opposite Decathlon, leave approximately 3-4 building, you have Hyderabad Stock Exchange. Decathlon is on the right hand side. This side is this and Hyderabad. That I think that went into bankruptcy in 2007. That closed. And now the property rate might have become so much that even if they pay everything, still they are in profits. So that is started working or not, I don't know, but that's Hyderabad Stock Exchange. Stock Exchange is nothing but it's a platform to help you buy or sell something. That's it. For example, NSE does what? It's like an online platform you have. The buyer and seller, it's a vegetable market if you ask me. It's an online vegetable market perfectly. It's a perfect vegetable market. Means earlier it was actually vegetable market when it was not the online. You'll go Reliance. Now everyone will be knowing. You might have seen the Harshad Mehta scam, maybe some part of it. Exactly same was it. Exactly same. For example, if I have to buy a share, I would stand outside that window and I'll tell, buy Reliance for me. And they'll say, Reliance. They'll say, Wipro. This is exactly used to happen. Their throat used to be, my uncle used to work and very closely I have seen him over that period. What exactly the problem comes? That was the market. That shifted to the online market. That's it. It's a vegetable market. And why I call it a vegetable market is there is a specific reason. Now, understand the philosophy of it. You will find, for example, if you would have opened up yesterday's paper, which I'm sure we might not have got the time, the heading would have been market fell, market bleeds, etc. It could be any kind of a reading would have come because Friday markets went down. When we say market went down, what does exactly it means? When we say market went down, Market went down means is in NSE there could be approximately 2800 or 3000 shares listed. That means these kind of a companies trade. In BSE we can have another. In BSE if I try to look, in BSE if I try to look the listed type of a companies, I could have if they provide data here somewhere. Let me check out main BSE website with me. Yes, if we try to look listed companies, if we say around could be 3800. Can you see that figure? Let's suppose this is the figure, although there could be some more SME platform and so on. 3800. Now what does it mean is, in BSE we have these many vegetables being sold. In NSE we have maybe 2800. It is not necessary that you have to get listed everywhere. For example, it is not necessary that my product has to sell on every platform. They have to pay a listing fees. For example, I just showed you a company called Aknit, that you can buy sell only from the BSE stock exchange, which is not listed on the NSE. It's not part of the NSE. Now when we say market went up and went down, what exactly it means is, what BSE has done, out of those 3800 companies, they have selected some 30 companies and they have put those 30 companies in a basket, or have made a bag of it, of 30 companies, and they have named it as Sensex. They have named it as a Sensex. That means whenever the movement of these 30 companies would come, that will decide market has gone up or gone down. For example, yesterday is a Friday because Saturday was a close. If I tell you the market went down by 887.64, that was approximately BSE website. Now if I try to click, what does this constituent? That means these are the constituents of this market which are there. If you look at, it's 1, 2, 3, 4, 5 vertical and horizontal, and multiply 6, 30 companies are there. The movement of these 30 companies will make market either move up or move down. That's called Sensex. Now in this case, some are in green and some are in extreme deep red. That means green have led the market up and red have led the market down. Average market was down 887. Now what happened because of Aknit? What happened because of the Ukal fuel? What happened because of TI Global? What happened because of Suzlon? Market does not care about it. They can move up and down. They will not impact the market. When you say market has gone up or gone down, when it says market is going down, it is actually you're talking about the average of these 30 companies. If you look at the extreme right, Wipro, I think Wipro, Infosys would be there. Infosys reported very bad numbers on the Thursday. It was not numbers bad. It was guidance was bad. Guidance is they were, I think they were expecting they give guidance. For example, when the result come, the management comes for the interviews. The analyst pose a question to them that what is your expectation, sir? For example, you ask, sir, what is the expectation? November 23 questions would come. I'll say very tough paper will come. You get demoralized. I'll say very easy paper will come. You get confidence. Exactly when they came, the analyst asked, what is your guidance? They were expecting a growth of a 4.5%, maybe revenue growth, I think 4.5. And they said that year is very tough. We might have a growth of only 1.5 or 1. And they've said only the language, this is, and the market has taken so negatively. That is the future expectation. What I'm telling you is exactly that means these, and because of that, the IT companies, all of them had a pressure. If one IT company is falling, that means if one is doing bad, it is assumed that everyone would be having a bad period in the next few years. So they fell. So right extreme red means market they have pulled down, and green means they have taken up the market. Now tomorrow when it opens up, the screen will change automatically. That means they put these 30 companies in a basket and named this as a Sensex. Sensex is nothing but name of that bag. Sir, can this bag change? Bag changes. Few companies come, few companies move out. For example, Satyam used to be part of it. So there can be few companies comes out, few companies go down. When we say market has always given a return, market will always give you return. You know why? If any company performs badly from here, they'll throw them out from here, and good companies they'll include. So market will never fall. In a short time it falls. This index was, I think, if you Google search out someone, I think Sensex was 100 rupee, 100. This is as of now, you know what is trading at 66,000. What does it mean 66,000? It means I think 1979 is the base year. Maybe some of you search out on the net, please. Base year of the Sensex. 1979 was the base year. 100 rupees of 1979 today are 66,000. Today are 66,000. So you can imagine, anyone you speak, any analyst will come. Very frankly, market always gives a return. Market will always give a return because it cheats you. It cheats you because any good company they'll put in the basket. And these are companies which are from some of the respected sectors and the leaders in that sector which is in higher in the market value, because higher market cap. For example, if some company does a scam or some problem comes in, just type in that base year, BSE, 100 rupees, 1979. Yes, my memory is okay. That means Sunday also I work properly. So it's 66,000 represents 100 rupees. You can imagine the kind of return it has given to you. And you will find everyone talking positive. I'm not a negative person, but you have to know the risk and return, please. That means if you invest in the market will always have only one feature. It will go up. It might become 1 lakh, but could be a possibility the companies which you see here might not be some of the companies at that point of a time, because any company which will be higher market cap in that sector will be representing or will be basically part of this. Now, why I call it as a vegetable market? Best example for your batch. You know tomato. What is the price of tomato? Whether you love, do not love, everyone will be knowing. Now, everyone knows tomato has become 150, 180. Did you ever care about, jamun? Jamun. How does it matter, sir? What rate it comes? Some of you might not even know. Leave apart. Mango. Leave apart mango also. Any fruit you tell me which is very rare. You try to become a smart now. Tell me any fruit which you only know, you think we do not know. Or anything. Don't remember. Let's take normal fruit only. Let's suppose lychee, cherry, for example. Lychee, you know lychee? Cherry. If the price, anyhow they come costly, if the price becomes 500 rupees kg or 1000 rupees kg, how does it impact your life? How does it impact your life? Some of you would be hearing, what is cherry, what is lychee, we have not even heard. What is jamun? Jamun is black. Jamun only, I don't know what you call English jamun, Hindi jamun. Nah, like, I'll show you physically. So what does it make a difference to you? Does it make a difference? But the tomato prices have become what? 180. Similarly, we might have seen some years prices of onion goes up and down. And you'll find a prime time news. Oh, look at this. The vegetable without onion, budget cannot afford. These kind of news item you start finding in the prime time news. And everyone talk about it. Everyone, stop eating for some time now. Like you do not eat jamun, you do not eat cherry, lychee, etc. But no one say. That means tomato, onion, potato. English, tomato, onion, potato, aloo, tomato, tomato, onion, pyaz. Aloo, tomato, pyaz. If anything happens to them, it certainly becomes every household item in news. It becomes, now the moment it becomes, that means these are items which impacts everyone. Now look at these kind of companies. You would be knowing about these companies. ICICI Bank, Reliance, Infosys, HCL, TCS. That means these are aloo, tomato, pyaj of the market. Everyone knows about them. Anything happens, everyone will say. If tomorrow something happens to Reliance, oh, Mukesh Ambani, Reliance. Anything happens to TCS, anything happens to Wipro, you would know. But I'll tell you, something has happened to Akanit Industries. Who is Jamun? We do not eat. Means, you can imagine, that means the market is so smart, they take only those kind of items which impacts everyone. So you should be knowing, and in fact, you find one more interesting fact here. That's a face of the economy. You find companies from IT sector, you find companies from the banking sector, you find companies from the L&T construction or the infra sector, you find company from the telecom sector. Is Bharti part of it? Bharti, yes, Bharti is part of it. Pharma sector, power. That means it represents the face of, if market is doing good, that means on an average we are doing good. But somehow a problem is any company which will not do good, they'll throw out from here and add a new company. Some changes came last of 1 month back also. I do not track the companies in and out, but some companies were added and taken out. I don't know which company was introduced and taken out. So you got the point. First point is, when market moves up and down, you should know what is moving up and down. What is moving up and down? It's only these 30 companies. I'll tell you one thing. Market went down drastically. Now I'll show you one more company. Any discussion done on any company is only for the educational purpose. This company was up 15%. We do not know what reason. Any news has come by chance? Let me see. No news has come. In fact, if you want to see now why it has moved up, first is the official website. This is BSE. Any announcement will come. Last announcement came on 5th July. That means nothing has come. There could be something which anticipation is happening, or maybe it was undervalued. company. And so look at this, after increasing also price by book value ratio is what? 0.99. That means you can imagine, if day before this I would have spoken about this company, the price was 140, previous close was 140. So what I'm telling you is market has gone down, but that particular company has gone up. So that means, does Ukal fuel impact the Sensex? No. That means only these. If anyone says company gone up or down, it should not matter. You should be only tracking your company. If you actively have invested in the fund which is related to the market, then it's okay. Second important part, after today's class, I should be expecting, if anyone says what is this 66,000? How do you read this 66,000? You have to tell them very clearly, 100 rupees of 1979 in today's term are what? 66. That means return has come. It means if you would have given a money to some portfolio manager and have asked, invest my company only in the Sensex, invest only in 30. If that changes, you change accordingly. And they have their respective weights, then that means your money would keep growing. And on an average, we have found return of a 12-15% you can keep getting. If you try to find out the return, you will be able to make the return out it. That's one part. Now, second part we are coming to is, now let's suppose Nifty. Nifty is another stock exchange. It's also one of the vegetable markets we have. In this, they have selected Nifty 50. That means they have selected basket of how many companies? 50, and named it as Nifty. It means when we say market has gone down in the case of National Stock Exchange, what would have changed? These Nifty 50 companies would have gone up or gone down, average of it. If I try to see, sir, the NSE website, that's National Stock Exchange, NSE India. This is NSE. The NSE also went down. If you look at percentage term, they should be almost same, 1.31, and that's a 1.17. It also went down, and but the base NSE Nifty value is 19,745. Sensex was how much? 66. Sensex is one of the oldest stock exchanges in the Asia itself. The base year was 1979. That means 100 rupees of 1979 today are how much? 6. Just take the base year of Nifty. I think it should be 1995. 1995 and 1000 should be the base year. Base year of 1000 and 1995. Now, what does it mean that 1000 rupees of 1995 in today's terms are what? 19. That means return has come. And if I want to see the constituents of it, does it show? It shows the most active, and let me view all. L&T, was it part of that exchange also? Yes. They are Nifty 50, and that was how much? Sensex. How many companies we had? 30. 50. This means 20 companies would be extra. ONGC, I don't know whether part of it was not. ONGC is not there, no? ONGC is not there. You have in Nifty. NTPC, I don't know. SBI was there also. Tata Motors. The falling part, let me see from the bottom. Infosys we had. HUL, Hindustan Unilever we had. So these are the name of the company. And interesting part is, to what my knowledge tells, whatever batches I have taken, hardly I find anyone who would not have heard the names of any of these companies. Otherwise, you would have heard the names of these companies: L&T, NTPC, SBI, Kotak Bank, ICICI Bank, Axis Bank, Bharti Airtel. That means these are aloo, tomato, potato, tomato, onions for you. So anything happens to them, it impacts. It impacts, and we know that. And they are some of the highest market cap companies of their respective sector. And they tell you basically what is. They basically tell you that if anything happens to them, let's suppose, is Adani Enterprises here included? No, just go back and check in January when you go back, or maybe check during the time, was it part of the Sensex or in Nifty in January or before that report came out. So you might find that could have been part. That means if something happens, that will impact. If something, let's suppose, happen to any banking company, any bank, let's suppose anything happens in ICICI Bank, that will impact the entire market. That will impact every one of you, and then automatically it will go down. It is but obvious, if the markets are falling for a continuous period, then certainly even the smaller companies, no matter if it's Wal, Fuel, Aknit or TI Global, any companies, they will get impact for sure. They will be getting impacted. In short term, it might be possible they might have gone up, they might have gone down. But if market remains bad, then no company can perform well over the long period of a time. That's one part of it. Second part of it is now tomorrow when market opens, let's suppose you would be seeing some more impact. Now, two things I've discussed. One, market will only mean the Nifty and Sensex will mean that 50 and 30 companies, and you will never say that it has all the companies average has gone down. It maybe they have their weighted average. Based on that, they calculate the up and down. Now, second part is when the tomorrow market opens up. Let's suppose Reliance is a heavyweight in the index. Reliance is a heavyweight in the index. Heavyweight is basically Reliance impacts market very heavily. Reliance reported Reliance was already down on Friday around 3%, I think, around 2.5%. Reliance was down, and results of the Reliance are announced on Friday. Friday means, for example, they have announced June results now. Now, let's suppose the September will end. Some Friday they'll decide, they'll announce the October results. It always comes after market hours on Friday. All companies have their own way of giving the result. Now, that means when the results came, the market was already closed. Now, what happened was the Reliance has GDR listed on. You know what is GDR? Reliance has GDR. GDR is Global Depository. Yes. RIL GDR plunged 6% in the London trading post Q1 results. Can you see that line? That means our market was closed when the result came out. It comes out around 5:36 Friday evening. Market closed 3:30. Now, what I am trying to tell you is how do you analyze or know that what could be the possible scenarios on Monday, tomorrow when we open up. RIL GDR were trading at down 6% after the result. GDR global deposit receipt. You will have practical questions on GDR in one of the chapters when we go forward. So GDS anyhow will come to you. It's theory you might have learned ADR and GDR in the IPCC interclass. You would have learned. Now, how much was Reliance down on Friday? 2.5. But evening, because it's a GDR is listed in the western side, the markets. That means it was open because we sleep. They were open. That means it fell down. It fell down. That means it reflects the difference of these two could be a possible reason. Monday we might feel some pressure on the Reliance. I'm not saying 100%. We might feel some pressure on the Reliance. That means if Reliance falls, by chance I'm saying, if Reliance falls 3%, it will be a heavy weight that will dent the Sensex and the Nifty again. So you should know, it is not that Reliance has reported loss. Also one thing please, it's not Reliance has reported loss. The Reliance basically, if you look at the Reliance results, they reported profit. Maybe Reliance estimates. If you look at, now look at this. Mumbai based Reliance net income fell 11% to this for the quarter ended 30th June compared to the same period as earlier. Comparative analysis they are doing. According to the exchange filing Friday, that missed the average profit estimate by Bloomberg survey of analysts. Bloomberg is one of the agencies. Analyst is those who track. For example, you are analyst, he's tracking, she's tracking, you are tracking, and as per you, this should have been number, but the number has not come. That means whatever price was appearing on Friday, they estimated that these numbers should come. For example, let's suppose the numbers, for example, let's suppose you go for the exam and I ask you how much will you score. You said, sir, 85 I'll score. Results comes out, and by chance result come out and you score 80. Your expression will be very bad because your expectation was what? 85. You score 80. Now let's suppose you go for the exam and you said, sir, 42 marks will come only. 42. By chance exam 47 number come. Now 47 is not good, but you'll still be happy. Expectation was what? 42. That is exactly what the expression of the market is. Now market expected something. It is not loss has come. Profit has only come, but what you expect has not fulfilled. That's why the pressure came. And since we were closed, ADR was open. It's not that shareholders can sell GDR because GDR has different type of bundle. That means they are listed on different stock exchange, Luxembourg and so on. So there's a different stock exchange. The people who were holding GDR, they would have sold it out. Monday we might find that pressure, might not find, but my guesswork says we might find a pressure because if that pressure was there on their listing. So that reflects, same thing happened in the Infosys. Infosys also has ADR listed, I think. Infosys ADR is listed in the, ADR is American Depository Receipts. That fell around 12% to 10%, and our Infosys fell by 8-9%. That means that shows the impact what happens. So this being the result season, and you are very fresh in the starting of the course, I expect you to read these kind of news items so that any companies pick up your choice and just keep tracking those companies for different events. You'll find something is happening in these kind of a company. So this was Reliance is part of a Sensex. That means we might find some pressure on it, and there could be a few more companies which will report numbers. And as they report numbers over the period of a time, then accordingly you can take a call whether the Sensex gets impacted. But there could be a possibility someone is taking the market down and someone is taking the market up. So that automatically nullifies the impact which comes out. So Reliance was the major impact which came out, and no other company. I think Vedanta also reported numbers. Vedanta, since it's not part of here, so I'm not discussing it. Vedanta also reported numbers. What kind of numbers came, I don't know. Is it fine? So that was our basic purpose of it. I think more or less I've discussed with you. You should be knowing after this class. You should be knowing few terms. For me, important could be calculation of the ratios, the payout ratio, because in going forward I might not tell you the formula. I'll say payout ratio is high, payout ratio is low. Look at the language. You have to take a call that if payout ratio is high or low, what kind of a company it is. We are in a growth phase, non-growth phase, and so on. Then we can have P ratio would be the most used ratio. Beta would be one of the most used term entire your course, and KPM is one of the most important method. This whatever we discuss, book value per share, etc. These will be on and off, which will keep coming in some places. The markets I discussed because since you're learning a subject and you go out anywhere and speak, you should be speaking very frankly, please. The market, you should be knowing it's a BSc, NSC, and it is only a platform which we have, and speak in such a language everyone understands. That's what I'm saying. It's a platform. Now, you used to have n number of stock exchanges. All shares might not be sold at all places. Those whosoever pay listing fees, they get the selling access. NSC and BSc, for example, some companies you can find only in BSc, and there is only few companies which are only on the NSC maybe. Spin Ball, for example, is on the NSC, it's not on the BSc. So there could be that possibility. And some companies which have a very high trading volumes give both the platforms. You need the brokers in between via which you can do the dealing. You cannot directly buy and sell. So brokers are there, those who get the license of the doing the trades on your behalf, which you find online. They have the license of the BSc and the NSC basically. And if Sensex moves down and up, means market moves up and down, the language will be very clear that some part of the 30 shares or 50 shares would have taken up and down. One thing which I also want you to do is, Reliance has demerged one of the arms which has happened since recently. You should be knowing that out on Thursday. It's a Reliance Geo Financial Services. Now, since Reliance was a heavyweight, it was standing at 2,800 rupees or 2,850 just before that split. After that, 269 or 270 rupees valuation they have given. Let me see. Geo Financial Services, because this Reliance now 3 days back, the Geo Financial Services was given 261.85. That means anyone who was holding a Reliance share will have the Reliance share as it is, will be given this share also. And post listing, this will be available for the trading. As of now, this is not available for trading. Now, index have been adjusted accordingly. Otherwise, what would have happened, for example, if Reliance was 2,800 and if you remove this part 260, 270 from here, so you will see a fall. But fall did not happen on that day in the index. Fall did not happen because index adjusted accordingly. Maybe temporarily, I think they have added Geo Financial Services as a part of the index. It will not be available for trading, but at constant price they've added so that stability come. For example, otherwise you find sometimes very recently we had a merger of HDFC and HDFC Bank. HDFC Bank, leave apart. You know Geo, by the, at least Geo you know, I think this should be knowing. Now Reliance was 2,800 rupees. Out of that you cut one part of 280, 260 rupees. Now if it happens it appears as if fall has come. If fall has come, market would fall. But it did not happen on that day, because what they did was they managed in such a way that 2800 became minus 261, but 261 was given some weightage in the index, I think. Index. Let me, these items I want you to get comfortable with time, because I would not be able to discuss so aggressively. Mm, Now let me read any of the articles I don't know. Now Reliance will become part of this. Look at this. How will look at this. Geo Financial Services will maintain in all NSE and BSE indices at constant price. Try to understand what I mean here. In case they would not have made this as a stagnant, then actually the index would have shown what kind of a fall, but which did not happen. It's very rare circumstances you have these kind of adjustment. It's a very rare circumstances. So what I expect is when you go back home, please make sure that, look at this. Reliance share opened at 2589 and trading at 2580, whereas just before that price it was trading at 26. Actually, demerger is nothing but in which one item, you have a piece of a land, it was cut, you are the owner of both. So one price became 2580, second became 261. So ultimately nothing happened to your wealth. So if nothing is happening to wealth, then index should also not take that hit. That is exactly what the adjustment came out. So these items I'm just igniting you, maybe for in some of the classes, let's suppose, because a couple of classes I told you very frankly base building is important. Once you get the flavor of these items, now I do not have to spend time on it. Wherever relevant or any news which I think is more important for you, I'll be discussing it out. Else there will be no use of discussion of these kind of items, and maybe I'll not be discussing so aggressively any kind of a company. If anything comes out, I'll just tell you in the class this news has come, go back and check. Or maybe at the end of the class 5 minutes or 6 minutes or couple of minutes I'll spend on any kind of a news item which is there, so that you remain the updated what is happening, and you also develop an interest in the financial markets. So when you open up the paper, you should be knowing what happens. So tomorrow when market tomorrow opens up, whatever happens tomorrow, Tuesday you find that heading will come, or maybe if you get paper of yesterday, the Saturday, you'll be able to make sure that whatever we have discussed, they would have mentioned exactly the same thing, and you will be able to analyze it out. It does not mean it's a buying opportunity or a selling opportunity. Should we buy or sell? It's not so. It's only that you remain aware of what is happening around. Is that fine? So let's take a break here. In fact, after break, should we start a new chapter or should we start tomorrow? It's up to you. How much time we have? 8. Let's do one thing. We'll start off tomorrow only, because after break only half an hour would be there. I'll not be able to make a base also in half an hour. We'll wind up here. Tomorrow we'll start up. Carry your books. In case you have your books, it's fine. Otherwise, take the book while going back home. For if uh, because I'll be requiring the book straightforward. We'll be starting one of the simpler chapters only, which will help you making English, help you in develop your concept. Tomorrow we'll start up. We'll wind up here only today. I think it's already 8:30, and enjoy your Sunday. It's fine. Thank you. Take care and bye bye.